Before dawn on Monday, September 15, 2008, lawyers for Lehman Brothers Holdings filed a Chapter 11 petition in Lower Manhattan, listing $639 billion in stated assets against $613 billion in debt, the largest bankruptcy filing in United States history. The firm had survived the Civil War, the Great Depression, and September 11th. It did not survive 1 week of September 2008. The standard telling says Lehman was killed by subprime mortgages. The autopsy disagrees. Lehman did not die of losses on the day it died. It died of a collateral run on a balance sheet levered roughly 30-to-1 and funded overnight. This is a story about repo, haircuts, and clearing bank collateral calls. The stock price was the scoreboard, not the game. Start with the balance sheet. At fiscal year-end 2007, Lehman carried roughly $691 billion of assets on $22.5 billion of shareholder equity, gross leverage of 30.7 times by the firm's own filings, which means a decline of about 3.3% in asset values erases every dollar of equity. And the assets sat exactly where 2008 was breaking: residential mortgages, Alt-A paper, leveraged loans, and a commercial real estate book crowned by the $22 billion Archstone apartment buyout, closed in October 2007 at the top of the cycle. The mortgage and real estate book alone ran roughly 3 to 4 times tangible equity, mark that book down 30%, and the firm is gone. Worse was how it was financed. Heavily in the overnight tri-party repo market, collateralized loans from money market funds intermediated by a clearing bank, JPMorgan, and renegotiated every single morning, a book that by most estimates approached $200 billion at its peak. Borrowing overnight against multi-year illiquid assets means one thing: the firm must re-earn the market's confidence every 24 hours or die. Which brings us to the window dressing, Repo 105. In the days before each quarter end, Lehman handed counterparties $105 of securities for every $100 of cash, and because that 5% haircut cleared an accounting threshold, the trade was booked as a true sale instead of a loan. No American law firm would sign off on the treatment, so Lehman routed the trades through its London entity on an English law opinion. The securities left the balance sheet for the reporting date. The cash paid down liabilities, and days after the quarter closed, Lehman bought everything back. The bankruptcy examiner's report puts the scale at $38.6 billion removed at the end of 2007, $49.1 billion the next quarter, and $50.4 billion the quarter after that. Enough to print second quarter net leverage at 15.4 instead of 17.3. None of it was disclosed to the board, to investors, or to regulators. Be precise about what this did. Repo 105 stayed secret until the examiner's report in March of 2010, so it did not trigger the run. What it did was corrupt the signal, because everyone pricing Lehman's risk was pricing a balance sheet roughly $50 billion smaller and meaningfully less levered than reality. And once trust in the reported numbers broke, the market began applying its own haircut to everything Lehman said, including, fatally, its liquidity. The market's immune system got there without the documents. In May 2008, with the stock already down more than half from its $86 peak, David Einhorn of Greenlight Capital told the Era Sohn conference he was publicly short Lehman at around $40 a share, attacking the marks, the leverage, and the accounting. From that day forward, Lehman was spending trust it could not replace. On June 9th, Lehman pre-announced a $2.8 billion quarterly loss, its first since going public in 1994, and raised $6 billion of fresh capital in the same breath. 3 days later, Chief Financial Officer Aaron Callan and President Joseph Gregory were removed. Capital answers a solvency question. It does not answer a trust question. September 9th was the hinge. Talks with Korea Development Bank, the last plausible outside capital, were confirmed dead, and the stock fell 45% in one session to $7.79. Short sellers were blamed then and since, but a falling stock cannot bankrupt a broker-dealer. What it does is tell every counterparty that the other counterparties are leaving, and that same day JPMorgan, the clearing bank at the center of Lehman's funding, demanded $5 billion of additional collateral. September 10th, a pre-announced third-quarter loss of $3.9 billion, packaged with a survival plan, spin the commercial real estate book into a bad bank and sell a majority of the Neuberger Berman asset manager. The market read it correctly. An amputation, announced by a patient too weak to pay for the surgery. Here is the kill mechanism most retelling skip. Every morning the clearing bank unwound the previous night's repos, returning cash to the lenders and carrying Lehman's securities on its own intraday credit until new repos settled in the afternoon. So for those hours, JPMorgan was Lehman's sole exposed lender, and its risk desk, not the stock market, held the off switch. In the final week, JPMorgan took roughly $8.6 billion of collateral, and Citigroup extracted a $2 billion comfort deposit of its own. Through all of it, Lehman advertised a $41 billion liquidity pool. The bankruptcy examiner later found that by Friday, September 12th, the pool was a fiction of encumbrance, most of it already pledged to the clearing banks, with only around $2 billion freely spendable. A secured lender does not need you to be insolvent to run. It only needs the possibility of liquidating your collateral in a fire sale, plus the certainty that whoever leaves first loses nothing. By that week, the run was moving through every channel at once. Hedge funds pulled their prime brokerage balances. Derivatives counterparties paid money to move their trades to other dealers. Major money funds refused the Lehman name entirely, and billions in repo simply failed to roll. Nobody needed to prove insolvency. They needed only to not be last. Friday night, September 12th, the New York Fed. Treasury Secretary Henry Paulson and New York Fed President Timothy Geithner convened Wall Street's chief executives and set the terms no public money. The template was Bear Stearns without the Fed, a private consortium absorbing the toxic book while a buyer took the rest. The bankers were willing to talk because none of them believed Lehman's real estate marks, and if those assets were worth half of book, the equity was already zero. Two bidders remained, and both doors closed. Bank of America walked away and bought Merrill Lynch instead that same weekend, at $29 a share. Barclays wanted the deal, but United Kingdom listing rules required a shareholder vote before it could guarantee Lehman's trading book. The British regulators declined to waive the requirement. No government would bridge the gap, and without that guarantee Lehman could not open on Monday. So the petition hit the docket before dawn on September 15th with roughly 72 hours of preparation, no financing lined up, and only the parent company inside it. The Dow fell 504 points, 4.4%, the worst session since September 2001, and a stock that had touched $86 traded for pennies. Roughly 25,000 employees worldwide were inside the largest bankruptcy ever filed, though the broker-dealer itself, notably, kept trading for days on tens of billions in Fed-backstopped advances. The structure of the filing multiplied the damage. Lehman sat on roughly 906,000 derivative contracts under more than 6,000 master agreements, and the bankruptcy safe harbors let counterparties terminate en masse at their own marks, at the worst prices of the crisis. In London, the broker-dealer entered administration with no cash at all. The parent had swept its subsidiaries' accounts to New York every night, and hedge fund collateral froze in place for years. Then the detonation reached the money markets. The reserve primary fund, $62 billion of supposedly risk-free cash, held $785 million of Lehman paper, wrote it to zero, and broke the buck at 97 cents. More than $40 billion of redemptions hit within 2 days. The run spread through the funds financing corporate America, and the Treasury guaranteed the entire industry by that Friday. The very next day after the filing, the Federal Reserve lent a IG $85 billion against a 79.9% equity stake. And the spread that prices interbank trust ran from under 100 basis points to roughly 365 within a month. One feared bomb never went off. Rumor put $400 billion of credit default swaps written on Lehman. The October auction set recovery at just over 8.5 cents on the dollar, and after netting, the actual funds that changed hands came to roughly $5 billion. The panic over the number did more damage than the number, because nobody could see the nets in real time. The reckoning, such as it was, came in October. Congressman Henry Waxman confronted Chief Executive Richard Fuld with a chart of nearly $500 million in compensation since 2000. Fuld countered the real figure was closer to $300 million, much of it in now worthless stock, and later academic accounting argued the chart was, if anything, low. Total criminal charges ever filed against any Lehman executive: 0. The contested core is whether the Fed could have saved it. Officials have said Lehman lacked the collateral for a legal loan. Economist Lawrence Ball went through the record and found no contemporaneous analysis supporting that claim, calculating the firm needed roughly $88 billion against about $131 billion of eligible collateral. His arithmetic is published. His conclusion is disputed. What is not contested? The very next morning, the Fed lent $28 billion against Lehman collateral to the broker-dealer it needed unwound quietly. The corpse was carved within a week. Barclays bought the North American Investment Bank and the headquarters tower out of bankruptcy for about $1.75 billion. The franchise it could not guarantee for free 7 days earlier, while Goldman Sachs and Morgan Stanley converted to bank holding companies, ending the era of the standalone American Investment Bank. Congress passed the $700 billion rescue 18 days after the filing, and the Dodd-Frank Act of 2010 built an entire resolution regime so that no $600 billion firm would ever again die overnight in Chapter 11. And the final ledger complicates the obituary. The estate ultimately distributed more than $129 billion, and the London unit eventually paid its unsecured creditors in full. Lehman was not worthless. It was unfundable, and at 30 times leverage on overnight money, those are the same thing on the day it matters. The mortgages made the run rational, the repo market made it fatal, and the accounting held the market's eyes shut until the exits were gone. That is the autopsy, and none of it is advice.